Hey, back again. This is Accounting 202. So this is financial accounting. This might not be the book you're using. It might be you might be have a newer edition, but still the same principles. This is Accounting 202. Still uses the same book as 201, but now we're on chapter 11, continuing on to the end. And so, welcome back. I'm Alex, accounting tutor, and chapter 11 is current liabilities and payroll. And I'm not gonna go over payroll too much because I'm gonna have payroll videos just for payroll because there's a whole class just for payroll. So we're not gonna hit payroll too hard, but we're gonna do the current liabilities and maybe some ratios. So we'll start with the introduction, which I like the introductions in these books. They're very short and sweet and to the point. So this is on Panera Bread. So buying goods on credit is probably old as business itself. True. In fact, the ancient Babylonians were lending money to support trade as early as 1300 BC. The use of credit makes transactions more convenient and improves buying power. For individuals, the most common form of short-term credit is the credit card. Credit cards allow individuals to purchase items before they are paid for, while removing the need for individuals to carry large amounts of cash. They also provide documentation of purchases through a monthly credit card statement. So you also get a statement, which helps out. Short-term credit is also used by businesses to make purchasing items for manufacture or resale more convenient. Short-term credit also gives a business control over the payment for goods and services. For example, Panera Bread, a chain of bakery cafes located throughout the United States, uses short-term credit or accounts payable to purchase ingredients for making bread products in its bakeries. Short-term trade credit gives Panera control over cash payments by separating the purchase function from the payment function. Thus, the employer responsible for purchasing the bakery ingredients is separated from the employee responsible for paying the purchase. Control. In accounting, you want to have control. So separation of duties gives you more control. If you have one person doing everything, that's how fraud happens. That's how you give too much power to one individual. This separation of duties can help prevent unauthorized purchases or payments. That way he's not paying himself or buying from himself or doing something shady like that. In addition to accounts payable, a business like Panera Bread can also have current liabilities related to payroll. Payroll is going to have liabilities. Payroll taxes, employee benefits, short-term notes, unearned revenue, and contingencies. This chapter discusses each of these current liabilities. So I'm just going to get to the meat of it. When a company or bank advances credit, it is making a loan. The company or bank is called a creditor or lender. The individuals or companies receiving the loan are called debtors or borrowers. Long-term liabilities are debts due beyond 1 year. Current liabilities are debts that will be paid out of current assets and are due within 1 year. The three types of current liabilities are discussed. Accounts payable, the current portion of long-term debt, and short-term notes payable. So accounts payable is your most basic payables account. For most companies, accounts payable is the largest current liability. So that would be like purchases on a normal account, 30 days to pay. You know, Walla Walla, what are you going to do? And then long-term debt is debt paid with longer than a year. And the thing is let's say you have like in this example, you have 5,110,000,000 in debt, but over 5 years. So you have 5 years to pay this thing off. Well, if you know you have 5 years, divide that number by 5, and you'll know what to do in this year. So like for 2010, if we know this isn't going to be paid till 2015 or what have you, we know that, okay, the first year, the first year we're going to owe 51 million out of that 110 million. So that whatever is due in that year is going to be current. The rest is still going to be non-current. So remember that. Short-term notes payable Let's say you bought um, like equipment on account, but you don't. Yeah, 30 days isn't long enough. You're not gonna have the cash to pay. You can go to the creditor or the business, the supplier you're getting that credit from, and say, hey, I need a little bit longer. Could you issue me a notes payable? So they're gonna debit your accounts payable, or on your books you're gonna debit accounts payable, and you're gonna credit notes payable. And so you're going from a 30-day accounts payable to a 90-day notes payable with interest. So now you're paying 12% interest because you have more time to pay. You're gonna pay a little bit of interest now. That's how lending money works. When the note matures, you'll pay the $1,000 back that you borrowed, plus um, the $30 in interest. And you say 30, why 30? It's 12%. Well, it's 1,000 times 12% times 90 over 360 banker's year. Remember, interest is only paid on the time you pay. Interest is over a year, 12% over a year, not 12% over a month. So interest really isn't as bad as you think. It's by month that you'll pay it. So 12% of 1,000 over 90 days is only $30 interest. And so you'll end up paying 1,030 back. Okay, you can also discount notes, which I might do an example on this one. A discount is when you sell a note to the bank. So you don't want the note anymore. You'd rather just get the cash. Borrow note, issue note. So what you did is you got the cash and you got the note. So let's say 4,000 issued by the bank, a 90-day 15% note. Well, they say that we'll buy it back we'll buy it at a discount, and if the discount rate is 15%, what you do is you take the maturity value. So you multiply the face value of the note by the percent by the days that the note is to get the maturity value. Then you take the maturity value times the discount rate, whatever the bank's going to give you for it, times the days left in the note. And that's going to either give you an interest expense if you made money, or an interest revenue interest expense if you lost money on the trade, or an interest revenue if you made money. And so I'll show an example on that. But you can always sell notes back to the bank at a discount to get some more if you need cash right away. That's another thing. Oh, and payroll. Payroll, we'll have a whole video series on that. But payroll is basically very important, governed by a lot of rules and regulations. You got to keep a payroll on each employee. I'm not going to hit that right now, but basically, Social Security, employee pays half, employer pays the other half. So employee pays half, employer pays the other half, same with Medicare. And that's going to be your FICA. So, and then also, the employee will also pay any other deductions they want taken out to come to their net pay. And then the employer will pay the payroll taxes, which is where you match Social Security and Medicare and pay state unemployment, federal unemployment. And that's payroll tax expense, your debit. So after you've done your office salaries and sales salaries and found out all their deductions and what they'll end up paying, that'll be your salaries payable. And so you have that's that vacation pay, pensions, all expenses, all payables that you have to pay into. It's expensive to have employees, especially if you want to retire them or pay their vacation. Now we have contingent liabilities. You might not have to do this in class. I'll just throw it in here. It's the likelihood. Contingent liabilities are liabilities that may or may not happen. So, like warranties. If you offer a product warranty, you can estimate that some of those warranties will be claimed or called upon. And so you have to estimate. Well, we say 5% of all of our products will have the warranties claimed on them. So you'll take the $60,000 in sales times 5% gives you $3,000 product warranty expense that you'll debit under credit product warranty payable. And that way you'll know you'll know how much you're gonna have to expense and pay. And then if someone does return something or wants something repaired, you would debit the payable and credit the supplies or whatever else you have or cash to replace the defective part or complaint under warranty. And the way you do contingency, if it's probable of occurring, then you estimate it and you record and disclose the liability. If it's not estimable, you'll just disclose it. And if it's not reasonably possible, you'll just disclose it. And if it's not remote and it's remotely, you're not gonna ever have to claim it, then it's none. And then here's the financial analysis and interpretation. Current position analysis. There's a working capital, current ratio, quick ratio. Working capital is current assets minus current liabilities. And that'll give you working capital, what you're working with. The current ratio is current assets divided by current liabilities. And the quick ratio is quick assets divided by current liabilities. And now the difference of the current versus the quick is the current is cash, temporary investments, accounts receivable, inventory, and maybe any other current liabilities. But no, mainly those the four I first said. You add them up, divide it by the current liabilities, which is accounts payable, and any other current, normally just the payables, and you'll get a ratio. So on this one we had a current ratio of 1.7. So that means for every $1.70 in current assets, you will be able to pay $1 on a liability. So you'll be able to pay your liabilities 1.7 times if you had to pay them right now. So that's a pretty decent ratio. But then the quick ratio is also called the acid test. It's where you take only cash, only temporary assets, and only receivables. The only stuff you can really turn into cash fast, divided by the current liabilities, will give you should be a smaller ratio. So on this one, the example is 1.3, which means for every $1.30 in assets, you'll be able to pay $1 in liabilities. So not a full double, but you'll be able to at least pay exactly what you owe and have a little bit left over. And then, and basically, the reason why inventory and receivables and investments are included in the current ratio is because, like, inventory you could send back to the manufacturer to get cash back. Accounts receivable you can collect them pretty quickly if you needed to, and then temporary investments you can always sell in the market, get some cash, and cash is cash. So that was chapter 11. I just wanted to get through the important things. Remember, payroll, we're not going to focus a lot on in this class, but it's good to know. And I can show you an example on some of these, but that's pretty much it. If you have any questions, feel free to comment. This chapter is not too invasive, so just a lot of pretty much liabilities, current liabilities, what you're going to use. So I'll see you I'll do the example. I'll do an example on this chapter. So I'll see you later, and I hope it helped. Thank you.